A $100,000 investment, left alone for 30 years at the historical S&P 500 average of about 10%, grows to roughly $1.74 million. At 7%, the same money grows to about $761,000. The difference is almost $1 million, and most of it has nothing to do with picking the next hot stock. It comes down to which 6 funds you own, which account you put each one in, and whether you can sit still for 30 years. If you are between 25 and 55 building a Vanguard portfolio you do not want to babysit, this video is built specifically for you. Vanguard now offers more than 80 index exchange-traded funds and another 60-plus index mutual funds. You do not need most of them, you need 6. But here's the part almost every video skips. Telling you what to buy is only half the job. Telling you which account to put each one in is where the real money is made or quietly lost. We will get to the placement map in a few minutes, and that is where the hidden cost shows up. Before we name the 6, let me give you the structural reason Vanguard sits at the center of this conversation in the first place. Picture 2 companies. One is BlackRock, listed on the New York Stock Exchange, answerable to public shareholders who expect quarterly profit growth. Another is State Street, also publicly traded, also accountable to outside owners. Now picture Vanguard. It was founded in 1975 with a mutual ownership structure. The funds own the company. The investors in those funds own the funds. There is no public stock to buy. There is nobody outside the system pulling profit out of it. You might be thinking, sure, but BlackRock and State Street offer plenty of cheap ETFs too, so does the structure really matter? It is a fair pushback. Competition has driven fees down across the industry, and iShares and SPDR products often match Vanguard on cost. The structural argument is not that nobody else is cheap. The argument is that everybody else has a built-in tension between fund holders and outside owners, and Vanguard, by design, does not. Over a 30-year hold, that incentive matters more than any single quarter of fee comparison. Now to the funds, 6 of them. Each one has a job. Fund 1 is VTI, the Vanguard Total Stock Market ETF. Its expense ratio is 0.03% as of April 2025. That means $3 a year on every $10,000 you have invested. VTI gives you a slice of essentially every publicly traded company in the United States, across every sector and every market cap. If you held literally nothing else but VTI, you would own a piece of the entire American economy, and Warren Buffett has spent decades arguing that for most people that is the right answer. He famously won a 10-year bet against a basket of hedge funds, and the index fund won by a wide margin. VTI is the foundation. Now you might be thinking, if VTI is enough, why am I about to hear 5 more funds? The honest answer is that VTI alone leaves international exposure on the table, and we will get to that one next. Fund 2 is VOO, the Vanguard S&P 500 ETF. It tracks the 500 largest U.S. companies, and that group represents roughly 80% of the total U.S. stock market by capitalization. Same expense ratio as VTI at 0.03%. 5-year annualized return through March 2026 was about 12.02%. If you have ever wondered which one to pick, VTI or VOO, here is the honest decision rule. Want maximum diversification, including small and mid-cap exposure? Choose VTI. Want the index that every financial commentator on earth benchmarks against? Choose VOO. Both are defensible core holdings. The difference over 30 years is real but small, and either one earns its place. Fund 3 is VXUS, the Vanguard Total International Stock ETF. As of March 2026, it holds 8,846 stocks from outside the U.S., with an expense ratio of 0.05%. Now here is where I have to be honest with you, because most videos are not. From 2010 through 2024, U.S. equities outperformed international equities by 503 percentage points in total. That is not a typo. The U.S. has crushed the rest of the developed world for over a decade. So why hold VXUS at all? Imagine a Japanese investor in 1989, fully invested in their home market, convinced Japan was the future. The Nikkei peaked that December and did not return to those levels for more than 30 years. International stocks led much of the 1980s. Emerging markets led the 2000s. Cycles exist. Holding 20 to 40% of your equity allocation in VXUS is not a bet that international will beat the U.S. It is insurance against the U.S. having its own lost decade. The objection that international has its own lost decades is true, and it is also exactly why diversification matters. You are not picking a winner. You are refusing to bet everything on one country. Those 3 funds are your engine. Now let me show you what keeps the engine from blowing up when the market tries to wreck it. Fund 4 is BND, the Vanguard Total Bond Market ETF. As of March 2026, it holds 17,358 U.S. investment-grade bonds, including treasuries, corporates, and securitized debt. Expense ratio is 0.035% from its prospectus. Bonds are not here to maximize your returns. They are here to keep you from selling at the worst possible moment. Picture this. October 2007, the S&P 500 hits a peak. By March 2009, it has fallen approximately 57% peak to trough. It does not surpass that 2007 peak again until March 2013, more than 5 years later. Now picture February 2020. The market falls about 34% in 5 weeks. It recovered by August of that same year, but during those 5 weeks, nobody knew that. The investors who held BND alongside their stocks saw their bond allocation hold steady or rise, which gave them something they could rebalance from. The investors who were 100% stocks saw everything bleed at once, and many of them sold. The bonds were not there to make money, they were there to make panic selling feel less necessary. You might be thinking, but bond returns have lagged inflation in recent years, why hold any at all? It is a real critique, and it is why younger investors with 30-plus year horizons can run lighter on bonds. The allocation should scale with your age and your stomach, not the other way around. Fund 5 is VIG, the Vanguard Dividend Appreciation ETF. It tracks U.S. companies with at least 10 consecutive years of dividend increases. Expense ratio is 0.04% as of May 2026. These tend to be mature, profitable businesses that survive recessions because cutting the dividend is the last thing they want to do. Now I have to give you the honest counter here. Since VIG launched in 2006, both VOO and VTI have outperformed it on an absolute and risk-adjusted basis. So why include it? Because VIG earns its place as a quality tilt for investors closer to retirement, or for anyone who wants a conservative slant inside their equity allocation without going full bonds. It is not a core holding. It is an optional flavor. Fund 6 is VGT, the Vanguard Information Technology ETF. Expense ratio is 0.10%. Over the 10-year period ending in early 2026, its annualized return was over 23%. That number is real, and it is also a warning. In 2022, the S&P 500 fell about 18% for the year. The NASDAQ 100 fell about 33% the same year. VGT is heavily concentrated in a handful of mega-cap tech names. Apple, Microsoft, Nvidia, and a few others dominate the holdings. When those names sneeze, VGT catches a cold. So it is a satellite, not a core. 5 to 10% of your portfolio at most, and only if you can stomach a year where it drops a third of its value without selling. If that does not sound like you, skip it entirely. There is no shame in not owning it. Now let me answer the question that has actually been on your mind the whole time. Where do these funds belong? Here is the rule that quietly costs people money for 30 years if they get it wrong. Bond interest, the kind BND pays out every month, is taxed as ordinary income at federal and state levels. If your marginal rate is 32% and you hold BND in your taxable brokerage account, you are handing roughly a third of your bond income to the government every single year. Hold that same fund in a Roth IRA or a traditional IRA and that drag disappears. That is real money. On a $10,000 bond position generating $300 of interest, you might pay nothing inside a Roth and $90 or more outside it. Compounded over 30 years, the gap is staggering. Same logic, different mechanism for the equity ETFs. ETFs like VTI, VOO, and VXUS use a process called the heartbeat mechanism. When authorized participants redeem shares, the ETF hands them low-cost basis stocks in kind instead of selling those stocks for cash. That means the fund rarely has to realize capital gains, so you, the holder, rarely get hit with surprise distributions. Mutual funds, by U.S. tax law, must distribute their net realized capital gains to shareholders every year. Even if you did not sell a single share, you can owe tax on those distributions. In a taxable brokerage account, that is a real annual drag. So in taxable, lean into the ETFs. Inside a Roth IRA, this entire calculation flips. Capital gains distributions from mutual funds are not taxable events for the account holder because nothing inside a Roth is a taxable event. The heartbeat mechanism's tax advantage essentially disappears. So in a Roth, pick whichever is easier for you to automate, ETF or mutual fund, it does not matter. Even FXAIX, the mutual fund equivalent of VOO, at a 0.04% expense ratio versus VOO's 0.03, is a perfectly fine choice in a Roth. There is one edge case worth naming. Reinvested dividends in a taxable account are taxed in the year they are received even though you never saw the cash. So even your set it and forget it automatic reinvestment is generating a tax bill every year, Roth IRA growth, by contrast, is fully tax-free, and qualified distributions taken after the account has been open 5 years and you are at least 59.5 are tax-free on both contributions and earnings. So here is the placement map. BND in tax-advantaged accounts whenever possible, your Roth, your traditional IRA, your 401k. Broad equity ETFs and taxable for the heartbeat mechanism. VIG and VGT, the satellites, are flexible, but a Roth IRA is the best home for the higher volatility, higher growth potential VGT because every dollar of growth comes out tax-free. That is the placement decision that quietly compounds into tens of thousands of dollars over a working lifetime. Now to the part everybody actually came for, the allocation. Here are 3 templates by life stage that you can use as a starting point. If you are in your 20s or 30s and you have decades to ride out volatility, an aggressive split looks like 60% VTI, 20% VXUS, 10% BND, 5% VIG, and 5% VGT. Heavy equity, modest bonds, a small tech tilt for upside. In your 40s, the moderate template eases off slightly. 50% VTI or VOO, 20% VXUS, 15% BND, 10% VIG, 5% VGT. Same bones, more cushion. In your 50s approaching retirement, the conservative template doubles down on stability, 40% VTI or VOO, 15% VXUS, 30% BND, 15% VIG. The classic 60-40 portfolio, 60% stock split between VTI and VXUS, 40% BND, is also a perfectly reasonable baseline at any age, and there is no shame in keeping it that simple. A friend of mine pushed back hard on the bond allocation for younger investors. His argument was that anyone in their 20s holding 10% in bonds is leaving meaningful return on the table. He is partly right, and that is the edge case. If you have a high income, a stable career, and you genuinely will not panic during a 50% drawdown, you can run 90-10 or even 100% equities in your 20s. The only person who knows is you, and the honest test is not what you tell yourself in a calm market. It is what you actually did in March 2020. 3 quick objections to clean up before we close. First, ETF versus mutual fund for automatic investing. The old argument was that mutual funds were better because they let you invest exact dollar amounts on autopilot. As of 2026, most major brokerages, Fidelity, Robinhood, E-Trade, now offer fractional ETF investing. The automation gap is gone. Second, Fidelity versus Vanguard. FXAIX, Fidelity's S&P 500 fund, charges 0.015%, slightly cheaper than VOO at 0.03. On $100,000, that is about $15 a year in difference. Both are excellent. The structural argument is the tiebreaker, not a deal breaker. Third, rebalancing. Research supports threshold-based rebalancing. Only rebalance when an allocation drifts more than 5% from target, as just as effective and more tax-efficient than calendar rebalancing. Pick the method you will actually execute and stop worrying about it. Here is the rule that determines whether any of this matters. The funds did not fail the investors who lost money in 2008 or 2020. The investors who sold did. Boring, mechanical, monthly contributions into the right funds in the right accounts is the entire game. You, the person in their 20s through 50s trying to build a portfolio without overthinking it, do not need to be clever. You need to be consistent. This is general education, not personalized advice. Before you act on any of this, talk to a fiduciary financial advisor or a CPA who knows your full tax picture. They will catch wrinkles a single video cannot. Open your Vanguard account this week. Pick the template closest to your age. Set up automatic monthly contributions, and do not touch it. If this changed how you think about your portfolio, that little subscribe button helps me know which videos to make next. Now, the natural follow-up question is which retirement account itself does the heaviest lifting? Most people assume their 401k and their Roth IRA work out roughly the same in the end. There is a number sitting inside almost every middle-class retirement plan that says otherwise, and it changes how you think about contribution priority. The next video on the screen runs the actual math on 401k versus Roth IRA. Go ahead and click it now.